Happy Thursday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Thursday, June 11th, 2026. As always, we'll start with the executive summary from today's lead-off morning note. So let's dive right in. Today's key macro question is, should the Fed look through the current bout of accelerating above target inflation? The short answer is no. If it does, the stock market bubble will continue to inflate. Three orthogonal vectors are combining right now to signal to members of the FOMC that they must tighten to combat the buildup of core inflationary pressure in the U.S. economy. Number one, the massive aggregate demand shock from AI CapEx is combining with pro-cyclical fiscal stimulus from ABA. Number two, the sharp slowdowns in labor supply and productivity growth suggest the risk of the economy overheating from a Nehru and output gap perspective is high. And number three, the monetary drivers of inflation are nearing dangerous tipping points that may begin to spiral if the Fed commits to easy money. Most importantly, none of these vectors has anything to do with the U.S.-Israel-Iran conflict, which means the risk of the Fed targeting the wealth effect channel to rein in price pressures this summer is much higher than currently assumed by the median market participant. Refer to our June 6 Around the Horn webcast titled, Is It Time to Party Like It's 1998 for more details. In terms of analytical nuance, the May PPI data supported the consensus outlook for peaking inflation. The May federal budget statement data did not. The May headline PPI, core PPI, core PPI ex trade services, goods PPI, and services PPI data strongly supported our sticky inflation theme, as did the May median CPI and trim mean CPI data, which are both in strong positive impulses at levels that are wickedly inconsistent with the Fed's 2% inflation target. Core PPI has been a leading indicator of core CPI and core PCE in recent inflation cycles. The structurally elevated peaks and troughs in core PPI perfectly presage structurally elevated peaks and troughs in core CPI and core PCE. The cresting of core PPI at 4.9% year over year in may be a harbinger of future good news on the inflation targeting front. The ongoing acceleration in headline PPI, which has been an equally prescient leading indicator for core PCE in recent inflation cycles, tells a different story. Specifically, the acceleration to a well above trend rate of 6.5% calls into question how much of the negative energy supply shock and positive AI demand shock will contribute to accelerating inflation in the core categories the Fed cares most about in the subsequent months. There is a credible case to be made that the Fed should look through the lagged impact of the negative energy supply shock upon inflation. There is no credible case to be made that the Fed should look through well above trend year-over-year rate growth rates of federal deficit spending, Fed public debt monetization, and bank credit growth, especially with the lagged impact of 175 basis points of rate cuts that are currently applying downward pressure on aggregate demand. There's also no credible case to be made that the Fed should look through the strong positive impulses in the growth rates of base money, narrow money, and broad money, especially not amid cyclically and structurally elevated levels of M1 and M2 money velocity. The only saving grace here is that both M1 and M2 are only growing at trend levels. Accelerations beyond these thresholds will shut down the look-through narrative. And finally, in the Eurozone, the ECB's decision to hike rates is consistent with the consensus outlook for sticky, well above target inflation. The ECB raised its 2026 and 2027 headline CPI forecast to above target rates, raised its 2026, 2027, and 2028 core CPI forecast to above target rates, and reduced its 2026 and 2027 real GDP forecasts to below trend rates. Hiking rates into anticipated stagflation signals the ECB is a central bank that is actually committed to price stability. How will the Kevin Walsh Fed respond to this signal? We shall find out. Is Kevin Walsh a patsy, or is he, and just been paying lip service to this whole price stability thing and protecting the families on the low end of the K, or is he serious about his hawkish, his legacy of hawkish views and as a defender of sound money and orthodox, sound economics and price stability? We'll find out. We don't know. That's a big known unknown right now. What his true underlying reaction function is, separate and apart from the process he had to undergo to get the job. And also we don't really know. Another known unknown is we don't know how the committee is going to respond to him, considering the fact that he's been hypercritical of them for years. So we're going to find out next Wednesday. We're not going to find out everything next Wednesday, but we're going to get the first signals next Wednesday. Markets, if the markets are going to like Kevin Walsh, that is an actual Hawk in Duff's clothing. So transition to our 42 macro dashboard here. As always, we wrap up with a question from our community. This was titled 42 macro money managers. If I were looking to one were looking to have their money managed professionally instead of DIY, do it yourself, are there any recommendations for trusted 42 macro money managers who subscribe to the 42 macro thesis and structure managed client portfolios to react based on 42 macro signals? Curious to hear if anyone has experience with this or have used any such service. So the answer is resoundingly yes. We do have a partnership that we're finalizing legal docs on that, so I'm not going to front run the announcement there. But yes, we do have a money manager that we are partnering with that is a wonderful track record, wonderful human being, great teams, and most importantly, thinks about risk management the way we do, and actually manages hundreds of millions of dollars of client assets with our signals. So if you want to get in touch with that money manager, go to 42macro.com/contact. You can just go to that from our homepage here, click on this hamburger menu at the top left, and then go to contact, and then shoot our team an inbound regarding this opportunity. So very excited about that partnership. It's going to do some great things for the investors in our community and the families in our communities. They have one of the world's best financial planners on their roster. So I'm excited about that personally as well as for our business. So we'll wrap it up there. Darius Dale here, presenting our macro minute for Thursday, June 11th, 2026. Best of luck out there today. We'll catch you back here tomorrow. Cheers.